Hi there, Jessica. Well, it was a brutal day for global stocks. China's benchmark main stock index, the Shanghai Composite, closed on Monday with its steepest drop in 8 years. That panic selling in China then spread to other markets in Asia, Europe, and the US. And for the latest on this global market sell-off, we hear from our correspondents on both sides of the Pacific, Timothy Pope in Shanghai and Liling in New York. We start in New York. Liling, it was a very volatile and very brutal day for the bulls on Wall Street. What happened?
Absolutely, Michelle. This was a harrowing trading session as a panicked sell-off in early trading drove the Dow Jones Industrial Average down by more than 1,000 points, and as Nasdaq and the S&P 500 also chalked up heavy losses. Now, by midday, there was a reversal of some of these losses, but not enough to keep the three main U.S. benchmarks out of closing in negative territory. The Dow Jones closed nearly 600 points down, while S&P and Nasdaq both lost 4%. Stomach churning, gut-wrenching, panicked selling sentiments that took hold Monday on U.S. stock exchanges as the U.S. followed global markets in a collective tumble. The trigger? China's stock market crash on Monday, as investors fretted over a slowdown in the world's second largest economy.
We've seen the emerging markets go from leadership, most of the 21st century here, leadership for emerging markets, into laggardship, and we've seen currencies start to crack. And we've also seen China, the fastest growing large economy, this caboose that historically that became the locomotive of global growth, has suddenly gone from a reason to be optimistic to a reason to be terrified.
But while China may have been the trigger, analysts here say it's not entirely the cause of Monday's Wall Street meltdown. Many also blame a U.S. stock market correction. Stocks have been performing well, even though companies are reporting slower growth, a sign that U.S. stocks may be overpriced.
People are beginning to understand that equities, common stock prices, are way too their prices are pushed way too high. And they've been supported, as I say, by these low interest rates, that governments cannot keep them forever low. When governments get in trouble, when currencies get in trouble, they have to raise interest rates. And that's what we're in now, a global, interconnected financial crisis.
Because so many nations rely on the U.S. and China markets as key engines of growth, market corrections in the world's two largest economies will likely continue to take a toll on the global economy. Michelle?
Well, Liling, definitely a rough day. Which companies were the hardest hit?
Well, in terms of the hardest hit, the energy sector took the biggest blow here as oil prices slid a further 6%. Among the major oil and gas companies, ExxonMobil and Chevron both lost nearly 5% in a sector that already has bled some $310 billion in market value so far this year. Now, the fear is that if China's economy continues to slow, it would further deplete consumer demand for oil, add to a global supply glut, and then further put downward pressure on the price of oil. Michelle?
Yeah, Liling, commodities certainly taking a beating lately, certainly no exception to that. Today, that was Liling 10 live for us in New York.